Welcome back to Fast Market, everyone. Kevin Hinks back here for our middle segment. That brings in LikeFolio.com. Scott Connor, always here with us as well. Now let's bring in the co-founder of LikeFolio.com, Mr. Landon Swan, to the show. He's going to take a look at a name that has earnings out before the open tomorrow morning, and that is the retailer of used cars, Landon, and that is CarMax. Landon, this company has to be doing extremely well with everything we know and everything we know that's happened to used car prices, Landon.
Yeah, I mean, imagine a world where your inventory is used car prices, and all of a sudden, used car prices are up basically like 35% over a year ago. It's insane.
Crazy.
I mean, this is a time when people investing in used cars and baseball cards are making a ton of money. This is like the bizarro world of investing. It's just kind of what happens whenever you mess with the free markets and weird things happen. So, their inventory obviously is going up, but so are their costs. When they acquire a new used car or used car from someone to resell, those costs are much inflated. And it all comes down to the chip shortage that we saw long ago, a few months ago. So, we actually put out a report on the chip shortage in June that included CarMax as a bullish play. I think it was around 117 at the time. So we're doing well on that, up around, I think, 13% or so. But what's interesting is the purchase intent, while it's soaring, it's plus 40% year over year, it's actually it's decelerating a little bit. The purchase intent for CarMax was at plus 57% year over year last summer. So now it's down to only plus 40, which is, again, a remarkable number. But you have to think about what investor expectations are, right? They know that used car prices are high. They know that used car sales are high because new ones are hard to get. And so it's all about what are the expectations of investors versus what are they likely to report. When you look at the fiscal quarter purchase intent and compare that year over year compared to analyst estimates, I think estimates are coming in around 7.34 billion. We're showing most likely around just a little bit above that, 7.49. So just a tick higher, maybe 2 percentage points higher, and that's really not LikeFolio's niche, is to pinpoint a 1 or 2% move in revenue. But I will say I don't think they're going to disappoint on revenue. I think really the key is where do expenses come in, because like many companies, they've got staffing problems. It costs a lot to get people in to sell the cars. They're competing with a lot of other companies that are paying higher wages. They're competing with unemployment. So the costs there are going up. The costs for the cars themselves are going up. And then they've got advertising costs. They've got to compete with companies like Carvana, who have really made a splash as well, and are actually beating them on happiness. So they're in a tough market, even though you'd think that everything is going their way. It's actually, they've got some hurdles to overcome. So if you look at just look at the happiness here, the two that are the top, Carvana and CarMax, doing fairly well. I mean, you're talking about people buying used cars, so I don't think the happiness should be extremely high. But then you've got Vroom, which is kind of the all-digital competitor, and they're just getting crushed. People do not like that platform. People are not happy with them. So I kind of discount them as a huge threat to CarMax, but Carvana definitely a big threat, as they both take that sort of omni-channel approach where you can either come in or you can do it online. So CarMax has a lot of things going for them, a lot of things going against them, but I think the read is, what do investors expect, and will they be pleased with really strong numbers versus expectation of exceptional numbers?
Got it. All right. Landon, I was just looking at Carvana and looking at the chart of that, because you did mention that these are both obviously in the same sector. But Carvana on the year, I was just noticing, is actually down about 8%. And if you go back to August, when it did peak about 376, dropped all the way down to about 218. So I'm just wondering, we're seeing the same kind of move lower here with CarMax, but not nearly to that degree. It's only down about 15% from its highs. But I'm just wondering, is this a reflection of just maybe the overall outlook for this industry, since it is so focused on used cars, like you mentioned? And of course, they benefited, I think, with the COVID situation and the chips and the delays in buying new cars. But if that starts to turn around and new cars become more available, is that a potential headwind, do you think, for this group?
Yeah, I think so. It's kind of tough to predict because, I've heard the anecdotal stories. I've got friends that work on the line on a Ford plant, and they're telling me that there's tons and tons of cars just sitting there, new cars waiting for the chip. And so, and I know that chip manufacturing is ramping up. So once those chips come out, the market could be flooded with new cars. And then all of a sudden, used cars are going to just absolutely tank in value. So then you're going to have the opposite problem. You're sitting on a huge inventory of depreciating assets, which that's the way it should be with used cars. So they got to move them more quickly, and prices are going to drop. The question is, when is that going to happen? And so I think that's really the key. That's the struggle that investors are looking at, is trying to figure out that timing, because the longer this chip shortage goes on and the more that used car prices go up and the demand for them go up, and you can see here plus 46% year over year. And what's interesting is, look at this uptrend. It's been going on for 4 years now. This is an uptrend in used vehicle demand. So people are preferring used vehicles, and of course the chip shortage is even pushing them further. But I think figuring out the timing is what's going to be really tough for investors, because you just don't know when those are all going to come online. Once they do, it's trouble for these companies. But until then, they're making money hand over fist selling these cars at inflated prices. So I think that's really the key. And you talked about how important used cars are to these companies. They do sell new cars. CarMax does sell new cars, but it's about 1 out of every 7. 6 out of every 7 are used cars. So that is the key for them. And again, it's just going to come down to how do they hit those numbers versus what do investors expect them to hit, because I think the revenue is going to be very high.
Yeah, Landon, all these stories that we're talking about all funnel into one constant theme, and that is the car industry right now is disrupted, right? I mean, used cars are in demand because there are no new cars. I've got a car dealership friend who said he's getting about 20 to 25% of what he normally gets in a month. So things are starting to loosen up, though. And so how do these guys play this? Because it's like musical chairs, right? When these cars start flooding into the market, anything that you bought at those higher levels is going to come crashing down in terms of margins on these, right? It's like whatever you're stuck with, you're going to be wearing for higher levels if you paid these higher prices, right? It's like the bid ask, right? For stock, for options, everything's higher. But when this music stops, these things are going to come crashing down, Landon, right?
I agree. And I think it comes down to how much inventory they have. Because if you think about the business, the model that they have, the workflow that they have, they're taking in used cars, they're turning them around and selling them. So it's just the period of shift that gets them, right? So the period where all of a sudden used cars are going through the roof, they benefited because they were holding that inventory. But now that used car prices are higher, they're paying more and they're selling them for more. So they're still making their margin, and it really doesn't help them that they're more expensive. So it's just during that change that they benefited. And it's going to happen on the other side as well. So during that change back where the used car prices plummet, their inventory value is going to get hurt. But once it gets down to those lower prices, they're going to be buying those used cars at lower prices as well. So all these people that have either a new car, they just bought a new car, they just bought a used car, when the market floods with new cars, their car value is going to go down as well. And when it comes time to trade in, they're going to be taking a loss on it, as it should be, and they're going to be giving it to CarMax at a lower price, which CarMax can then flip. So I really think that it's just a very short window, and if they manage the inventory correctly, then it can be not as painful as, they can reduce the pain from that point. But the trick is managing that inventory, because they don't want to be sitting on a ton of cars when that crash comes. But at the same time, they've got to have cars in their inventory to sell to people. So this is the conundrum that they're in, and that fine line that they've got to walk. Tough business to be in right now.
It's interesting, Landon. I was looking at the last couple of earnings cycles and what kind of move were the markets expecting before they announced those earnings. And what I did is I looked at what's called the average, or the at-the-money straddle, right? So it's the at-the-money call, at-the-money put. And they were kind of looking for something between a 5% to maybe 6 or 7% move. I just looked at today's, and it's over 10%. So this is almost double the expected move that we've had in some of the most recent earnings releases. So it looks like they're expecting maybe some volatility that's outside of the norm you think that's just reflecting what we just got done talking about, you know, about the potential for new cars coming back onto the scene and the value of used cars and demand lessening as well?
Yeah, I think so. I think probably it definitely reflects that, but I think more than anything, it reflects uncertainty because this is a very difficult problem to figure out with many moving pieces. And you know, from our experience, just all of us looking at the supply chain issues, this doesn't seem like an issue that can just be resolved overnight. Like one day, there's going to be a million new cars on the market. So I think this is something that you'll have more certainty moving into the future if you're just a little bit patient. And I think that the people right now may be overpaying for these options because I think a 10% move is just really based on uncertainty. So we do like this company longer term. You know, like I mentioned, we were bullish since June. I think the chip shortage is still an issue that is going to just help this company. Eventually, it's going to hurt them as it reverses. But right now, it's helping them. So I say long term. I'd go back to say medium term. I say medium term, we're bullish on this company. Going into the report, our score is fairly neutral, so we're kind of sidelines right now. But if there's any big sell-off, if they do get that 10% move and it's to the downside, I think that would be a good opportunity to pick up shares. And I would even consider selling some puts and getting some of that premium because I think that may just be a little bit overstretched and it's based, I would guess, on uncertainty.
So your reading is neutral, you said, on this, Landon. We'll take that from there. Landon Swan, co-founder of LikeFolio.com. We appreciate you coming on the show. As always, we'll see you tomorrow. Have a great day, Landon. All right, Scott.